Have you ever stopped to think about the money in your pocket or, the numbers that pop up in your bank account? Where does all of it actually come from? And how is it that banks seem to just create it? Well, today we're going to pull back the curtain and demystify the incredible system of money and banking that pretty much runs our entire world.
Okay, just imagine for a second. You want the brand new smartphone, but instead of money, you have to pay with chickens, right? So you'd have to find someone who not only has the phone you want, but also, right at that moment, needs exactly 50 chickens. It's a logistical nightmare. This whole mess is called the double coincidence of wants, and it's the biggest flaw in any barter system. It's slow, it's awkward, and let's be honest, probably very noisy.
Luckily for all of us, humanity figured out a brilliant solution to this problem. A tool so powerful it would completely change how we trade, build cities, and create entire economies. And that invention, of course, is money.
All right, so let's start right at the beginning. What really is money when you get down to it? And what are the fundamental jobs it does for us every single day?
Now, I know this definition sounds a little textbooky, but it's actually incredibly important. See, money isn't just about the paper or the metal. It can be anything, as long as we all agree it can do these four specific jobs. It's all about our collective belief in it. If we all decide it has value, then it does. It's that simple.
So this first one? This is money's #1 superpower. It's the ultimate middleman. You don't have to trade your work directly for food. You trade your work for money, then you use that money to buy whatever you want. It totally gets rid of that double coincidence of wants. No more chickens required. And the second key job is that money lets you bottle up your hard work and save it for later. Unlike those chickens, which have a limited shelf life, money is designed to hold its value. You can earn it today and spend it a month from now or a year from now. It's what allows us to save and plan for the future.
So this here breaks it all down nicely. You've got the two main jobs, being a medium of exchange, which we just talked about, and a measure of value, which just means it's a common ruler we use to price things. Then you have the two other jobs, being a store of value so you can save, and a standard for deferred payment, which is really just a fancy way of saying it makes loans and debt possible. All four of these have to work together.
Okay, so we know what money does, but how much of it is actually out there? That's what we're tackling next. How do you even begin to measure all the money in an economy?
So the grand total of all this money is called the money supply. Now here's the important part. We're only talking about money held by the public. You, me, companies. We're not counting the stacks of cash sitting in the government's or the central bank's vaults. Think of it like taking a photo. It's a snapshot or a stock of all the money in circulation at one particular moment.
The most basic way we measure this is something called M1. This is the stuff that's easiest to spend. It includes all the physical cash and coins we carry around, plus all the money we have in our checking accounts, what economists call demand deposit since you can, demand it back instantly. This is the most liquid form of money ready to go at a moment's notice.
All right, now we're getting to the really mind-bending part. We usually think the government just prints all the money, right? Well, yeah. They print some of it, but the vast majority of money is actually created by commercial banks. Every single time a bank gives out a loan, new money is born. So how does this magic trick work?
At their very core, banks do two main things. They take in deposits from all of us, giving us a safe place to keep our money, and then they give out loans to people who need to borrow. It's this simple back and forth between deposits and loans that, believe it or not, is the engine of money creation.
Now, the secret ingredient that makes it all work is a rule called the legal reserve ratio, or LRR. All this means is that banks are not allowed to lend out every single rupee they take in. They have to keep a small fraction, let's say 10% in reserve, just in case people want to withdraw their cash. But the rest of it, that's fair game to be loaned out.
So check this out. Let's walk through it. Say you deposit 100 rupees in a bank. The bank holds on to 10 rupees for its reserve. Then it loans out the other 90 rupees to someone else. That person takes the 90 rupees and buys something. And the seller then deposits that 90 rupees right back into the banking system. And there it is. The cycle starts all over again.
And this is where you see that amazing ripple effect. That second deposit of 90 rupees, the next bank keeps 10% of that, so 9 rupees, and loans out the other 81. And on it goes. But just look at the total. Our original 100 rupees became the foundation for 1,000 rupees in total deposits. The banking system literally created 900 rupees out of thin air. It's wild.
And this whole phenomenon is called the money multiplier. The math is actually pretty simple. It's just 1 divided by the LRR. So in our case, 1 divided by 10% gives you a multiplier of 10. That means every new rupee deposited can create up to 10 times its value in the economy. This is the reason you can go out and get a loan for a car or a mortgage for a house. It's this system working behind the scenes.
So, who's in charge of all this? Who makes sure the banks are following the rules and the system stays stable? Well, that's the job of the central bank. Think of it as the boss of all the other banks, the banker's bank.
A central bank wears a ton of different hats. It's the only one allowed to print currency. It's the government's personal banker. It's the bank for the banks holding their required reserves. And, maybe most importantly, it's the lender of last resort. If a bank is in trouble, the central bank can step in to help. It's basically the conductor of the whole economic orchestra.
Now, because the central bank sits right at the top of this pyramid, it has some really powerful tools at its disposal, levers it can pull to influence the money supply and help steer the entire economy.
One of its biggest levers is called the repo rate. This is just the interest rate the central bank charges commercial banks when they need to borrow money. So if the central bank raises the repo rate, it gets more expensive for banks to borrow, so they lend less and the money supply shrinks. If they lower it, borrowing gets cheaper and the money supply grows. Simple as that.
Another major tool is something called open market operations. Sounds complicated, but the idea is actually very simple. If the central bank wants to pump more money into the economy, it buys securities from the banks. This gives the banks more cash to lend out. If it wants to shrink the money supply, it sells securities to the banks, which soaks that extra cash right back up. It's kind of like a giant economic sponge.
So, to bring it all home, this table sums it up perfectly. You've got the central bank, which is all about public interest and keeping the economy stable. And then you have commercial banks, which are businesses out to make a profit. One is the referee for the whole system, the other is the player we interact with every day. Both are absolutely crucial.
You know, from trading chickens to using paper bills to just tapping our phones, money is constantly changing. And that leaves us with a pretty big question to chew on. In a future of digital currencies and crypto, what will this system even look like? Who, or maybe what, is going to be the banker of the future? Something to think about.